All right, we have Jesse Daberkoe in here. Thank you for coming in, Jesse.
Sure. Thank you for having me.
I've been waiting for you to come in. Okay, so what exactly do you do?
It's $1 million question, right?
Yeah.
No, I'm actually a financial banker for specializing in mortgage in residential and commercial finance.
Okay. So like, what is that exactly? Like, for
What is
somebody
that
who
in the
doesn't
layman's
know.
terms?
Yeah, layman's terms.
So what we
yeah.
do is we help homeowners get into their residential homes for any primary residence, investment properties, also on the commercial aspect, any home business owners. Go into anything with multifamily, single families, basically all the above, anything based on residential or commercial division side of real estate.
And then what got you into that? So like you're going through school. I know you went to Wellington High School, and then you went to college. Would you go to FSU?
FAU. I had
FAU. I was
I had a background in finance, so got into a couple different sales positions and really just fell in my lap. Believe it or not, I got in the finance industry for banking in 2008. So it was an opportunity. A friend that was actually doing it presented to me, fell in my lap. I took a look at it, saw, hey, these guys are actually making money, doing the right thing. Not little did I know that it was in a financial crisis in 2008. So it kind of was a little bit of a hindrance, but I didn't know any better, so we got into it. It was starting from the nutshell, it was really getting into the finance inside of it, where that's really everything was. Again, interest rates were extremely low at the time compared to where they were previously, just due to the fact of the economy. Everybody getting into a situation where a lot of foreclosures were happening, values were upside down, so on and so forth. So it was a big opportunity for people to refinance. Fannie Mae, Freddie Mac, I'm sure everybody's heard of that. Big entities actually released a lot of programs to allow people to take advantage of lower rates, stay in their homes, implement a lot of government programs to assist that, to kind of slow down or prevent foreclosures. We've all heard about the financial collapse and meltdown, so that's definitely something that kept everybody afloat in the mortgage industry side of it. Before that, everybody was turning and burning purchase market. You heard a lot of things about the stated loans. I'm sure we'll touch base on that here later in the queue, but
yeah.
There's a lot to go into.
So basically, you finish up and then you get into the banking, and you decide to go into the banking, and right when you decide to go into the banking, the '08 crisis hits.
Yeah, so the crisis actually hit. I was in like a construction sales position, and I was kind of drying up. And like I said, a friend of mine kind of presented this, said, hey, this is what I've been doing. I've been doing this for years. I think you'd be great at it. So I came in, took a look at it, and at that point kind of said, hey, okay, these guys look like that's something going on here. This is something that I want to advance my career. I've had a finance background, so kind of fell into place. But again, the crisis kind of already occurred. Obviously that didn't come up in the interview, but they didn't bring that to my attention. But it did throw a little hindrance in there when I actually sat back and did a little more research. But again, with the opportunities were out there and how busy the office was, it was a great opportunity.
What do you think actually caused the crisis?
You know what? Everybody asks that all the time. A lot of people think that it was the banks that actually loosened up their guidelines or changed the rules or got greedy. Now, could that be possible? I could say yes, but a lot of it was really not the actual. It was more the buyers wanting to get into houses that they couldn't afford, and the banks kind of allowed that, I guess you could say, in a way, by loosening up the guidelines to allow them to the stated loan programs, not doing the due diligence on actually the verification of the borrower to confirm that they could actually afford the property.
So if I'm following you right, so like at one time you needed, let's just say 680 credit to get this house.
Sure.
The banks lowered it where if you have 610, now you can get the house and you make $30,000 a year. Now there's no way you can afford that mortgage and food and everything else, but the banks loosened it up to approve the loan. Is that kind of what happened?
Yeah, and per se, a lot of programs that were out there. I'm sure you've heard of negative AM loans. The whole thing is when a market actually is appreciating at a fast pace, everybody wants to jump into it, all right? It's attractive. It's kind of what we're seeing in a way as of today, and we'll go into that a little bit of what the difference is kind of from 2008 to where we're at today in 2020. But back then, in say 4, 5, 6, and 7, right before the crash happened, a lot of people were on stated loans. You had people that were working at the grocery store, say pushing out carts, wanting to get into a $400,000 house, and because the bank loosened up their guidelines, a lot of times you could do stated loans to where you had a reference letter. So for, say, you could get a reference letter from your neighbor saying that you walk their dog 6 times a week for X amount of dollars, and that would qualify for income. So this is all before my time, but these are the horror stories that I kind of hear.
Now, what do you think was behind that, though? There had to be a driving force behind that, right? Because these banks knew that they weren't going to get paid, right? I mean, Don't
You would
think?
assume so, right? But
Right.
I think what happened is when they're deploying that much money, right, and they built a machine, is once people only buy so many houses, right, at a certain time. So, well, in that aspect, a lot of people were buying investment properties, things like that they probably didn't know what they were getting into. But in the same aspect, when it came to that, it's really they still had money to push out, right? So a business is roaring like that. They're deploying X amount of dollars per month. You can't just stop that machine from moving forward, right? You still got to feed the beast. So the only way to do that is kind of apply and approve people that aren't as qualified. So what do? You got to lower your guidelines. You got to increase what's called a debt to income ratio. You allow it to go a little higher. You reduce the credit score requirements. So there's a lot to it that they like peeled back because, again, when you don't have enough qualified buyers, what do? They change the guidelines. So that's kind of really how it got into that aspect.
So kind of like they were going down, but let's just say loans were going down because their guidelines were so high. So they were, just to make it like simple, and tell me if I'm wrong, they were losing money. So to keep the beast going, what they had to do was say, okay, we're going to lower from 680 to get 400K, 680 and 200,000 a year to 50K a year and 600, and we're going to give you a loan just to keep that machine going.
Yeah, they had the money to deploy, right? And again, if they ran out of qualified mortgage applicants, how do you get more qualified mortgage applicants?
You lower
right? The requirements,
Yeah.
right? So now you have more people that are applying for it and actually getting qualified. So they just keep, again, deploying X amount of dollars because it's moving off the shelf as fast as bank would go ahead and close the loan on a Friday. By Monday, that's being already sold on the secondary market.
And is that what happened basically with the bank bailout? Is it just got too extreme and then they had to bail them out?
Well, that's another thing too. It's when you get to a certain point and you're too big, certain banks couldn't crash because that would cripple the economy even more in that aspect. If it actually went down and under, right? What would that done to the economy? So what's the lesser of the two evils?
Right.
Is what I think that they sat back and looked at and said, okay, we got to keep this moving forward. We can't have everybody in this situation. So that's when they kind of rolled out some of the government programs where there wasn't appraisals needed because a lot of people were upside down, but it allowed them to reduce the interest rate. People that were in bad loans or predatory loans is what they were called, like negative amortization loans, where basically you make a payment every month, but your principal continues to grow. So
what does that mean, like in layman's terms?
So say for example, you went and bought a house for $300,000. There was loans out there that you would actually go to the closing table and you could get a check back because everybody was basically putting all their coins on that the market was going to continue to appreciate. So there's loan programs out there that were used that kind of catered to a certain borrower themselves, but there was also some banks or people in the banking industry that kind of utilized that to go the wrong direction. So for an example, what's called a negative amortized loan. Think of it that way.
Now,
right?
what is that though? Never even heard that.
Okay, so say for example, you go buy a house for $300,000. There was actual programs called Pick-a-Pay, where you could get 3 different options of what you wanted to pay on a monthly basis. Now, most people, right, they want to go with the lowest payment. So what that would be, say for example, you bought a $300,000 house. This is just for examples, right? And you picked your pay of $1,000 a month. Now, your real payment should have been $1,500, but you're only paying $1,000. That extra $500 is going to the back of your loan principal, so you're not paying down your loan. Your loan's increasing. So you're getting a house of your dreams that you really can't afford for a low payment, but your principal is actually growing on the backside.
Oh, okay.
And people jumped into that just because, again, they want the dream home for them and the family. And the whole aspect was, okay, if it keeps increasing in values, then we can always refinance you out of it. But a year later, 2 years later, whatever the case may be, the economy crashes, the value's not there, you're still stuck in this loan. And some of them had what's called a balloon. A balloon payment's basically saying, we'll let you into this loan for, say, 3 years, and this loan's going to become due in full at the end of that 3 years.
So then you have 3 years to pay that whole loan off?
Pay it off, refinance it, get out of that exact loan product. So it was the loan was there for certain reasons, but I think it was kind of abused. So that kind of put people in bad positions. And then when the economy kind of crashed, how can you refinance something if you don't have the equity to do so?
Right. It's like, you didn't have the money to get it to begin with.
Sure.
So now how all of a sudden are you going to come up with the money to all of a sudden pay it off?
Exactly.
So now if you go to refinance it, right, you still have the same credit. You're still making the same amount.
Right.
At that time, were they given refinances or were they lowering it on that too?
So there's some loan programs that came out that were actually getting rolled out right when I got in the industry. Fannie Mae and Freddie Mac allowed certain programs to take advantage of the lower rates. but you wouldn't have to have an appraisal done if you qualify for qualified borrowers.
Really?
So because they already own the loan, so they thought of it. Okay, great. Why don't we let these people take advantage of where rates are today? Because if not, they're going to go late on the payment, right? So they're going to go into foreclosure. So we have a bad asset on the books, or do we allow them to lower the monthly payment and at least afford the house and keep it?
Wow.
Because at the end of the day, they have to foreclose on it. There's costs in doing so. There's carrying cost, and then you got to resell it. And you times that. It doesn't sound like a bad idea when you have a couple of them, but tens of hundreds of thousands, right? You're sitting on quite a bit of assets.
Now, do you think, not like a conspiracy thing, I mean, just do you think that was any type of like setup, like they knew they were going to get bailed out if they went that route, but they needed to keep the beast going?
I can't really per se on that. I'm sure that, like I said, a lot of people made a lot of money, and when a lot of people make a lot of money, they look back at it and they try to go after it, but they folded. Big banks kind of folded in some instances, but they were too big to fail. So there's a couple movies out there like the Big Short.
Yeah, you and Gary in The Big Short, and The Boiler Room.
Yeah.
And what's the other? There's one more he kills me to
Glengarry
watch.
Glen Ross.
That one, and his 1930 movies too.
Yeah, I've seen some of those. Yeah.
Yeah, you actually watched them?
I tried. They're terrible.
What do you watch? About 15 minutes and run?
Yeah, exactly. It's just I don't have the interest in it. So.
Yeah, it's like too old.
Right.
So you're in the banking, and then what leads you from the banking to the next phase of your life?
So really, I was actually been with the same company in the same office group since I got in the industry.
Oh, wow.
Yeah,
Okay.
you don't really hear that a lot, to be honest with you. A lot of people jump
Never
around.
hear that.
Yeah, again, in this industry, a lot of people either are staying in the same group for quite a bit. I've been working with the same guy that's hired me since day one. We're basically close to being partners in the office now. So
Almost 20 years.
13, yeah, 13.
13. Yeah.
Too much, man, too long.
Okay, so and now you go to you get all this stuff done, and then so you've been with Absolute Mortgage, right?
Absolute Home Mortgage, yeah.
You've been with them that long?
Yeah.
Okay, so when you first got there, what was your position?
I was a junior loan officer. So basically, I was kind of like the phone guy. Here, call these leads. Here's the trashy leads. Take some of these because it was a refinance business. So we're really calling on like mortgage inquiries, refinance inquiries. Somebody goes online, they see, hey, there's a lot of low interest rates, so on and so forth. They take their name and their information, and those companies basically turn that into some type of lead, and they sell to companies where we call and follow up on.
Now, like when I hear that, right, automatically I think of the Wolf of Wall Street.
Right.
What I mean, not that you were involved in anything like that, but
Sure.
Was that the kind of thing it was? Like everybody's sitting there, they're just calling. I mean, I know that's stocks, but
Yeah, no, it's not really like the style of the movies, right?
Yeah.
What you're doing is you are hammering out a lot of phone calls, and that whole opportunity is to basically help people and get them out of a situation that they're in. So we're either lowering their interest rate, we're lowering their monthly payments, we're giving them cash out to take basically equity out of their home to pay off debt for debt consolidation. So these days you can't even write a loan to put somebody in a worse position.
right now you can't.
It can't. You have to. It's what's called a net tangible benefit. So every loan that's underwritten is being reviewed, and by an underwriter to make sure that obviously it's it's a creditable borrower, and B, that has net tangible benefit for the borrower. So you can't put people in worse situations, really.
So from the time you came into the business, when you got with Absolute Home Mortgage,
Mm-hmm.
and you're doing loans to now, what is the difference you've seen with the underwriters?
You know what? That's a great question. We've seen the ups and the downs. When I say that, basically, guidelines do change. The one thing about this business is it does change constantly. So guidelines get tweaked. Certain requirements come out and get changed often. So it has been a little bit tighter. So going back to 2008, right, I think it was probably some of the tightest guidelines from what I'm being told as well, because that's when I got into the industry. But like I said before, you could close loans with reference letters, with basically saying, hey, I pay this guy to cut my grass X amount of dollars, and that's qualifiable income. So they weren't so strict on qualifying, because at that point, it was the heyday. Everybody was making their payments. Everything was appreciated. Nobody really cared, right? Because it wasn't a problem until the music stopped, per se.
Yeah.
When that basically happened, the guidelines kind of got extremely tight. Appraisals weren't coming in. They were upside down because foreclosures were obviously decreasing and declining in the market rather than appreciating and increasing the market. So from then till now, the big difference is verifying. Everything's verified in today's market. We verify the people's income, we verify their assets, we verify their credit, their debts, to make sure that they're in a position that when we write the loan, that they're going to be able to pay it back.
So there's no more like fake pay stubs.
Yeah, I hope
that
not.
stuff.
I sure
yeah,
hope
you
not.
know,
Yeah, there's all types of
it
verifications.
just comes crashes back down. It
Yeah,
just kills
absolutely.
everything.
Sure,
You know,
sure.
and that that's interesting because I used to deal with a lot of merchants.
Okay.
And the way they used to be is, I mean, pretty much they would approve you, and if they would maybe give you $20K, $30K, and if you had, less than 2% chargeback,
Mm-hmm.
and you were at the $20K, you could call them and say, hey, look, business is doing good. Can you up my limit to $40K?
Right.
And they say, oh, well, we've talked to an underwriter, the risk department,
Sure.
and then they'll give you 30,
Right.
right? And then you have like your high ticket, your low ticket,
You're
whatever.
talking about like credit card merchants?
Yeah, yeah.
Okay.
I'm just comparing the two.
Sure.
Now, to get a merchant is like a whole thing.
Right.
Like their guidelines went crazy
Sure.
because probably kind of like happened in your industry with like fake pay stubs and the guy next door writes you a letter that says, he walked
Right.
the dog 17 times.
Right.
Well, now these merchants are back then, the merchants were given like $100K like nothing.
Right.
Well, just like with a loan, you have to send in, pay or not banks, 6 months of bank statements, what you make. Well, anybody can edit a bank statement. You know what I mean?
Right.
So then they were giving them to them, and then they were using that merchant for things they shouldn't be using it for. So you would say you have a curtain website, but you're actually using it for not a curtain website. You know what I mean?
You're
and
now, Ferrari.
yeah. And now it's just like a nightmare.
Yeah.
So, I mean, that's kind of like what you're talking about then, I guess, right?
Yeah, that like I said, that was before my time. But again, being in the industry now and having some, we call them old dogs in the office, and veterans have been doing this a long time, I always pick their brain. I always want to learn from people that have been doing it longer than me, right? So we, again, there were guidelines that were made. Now, there were certain people, and a lot of people were in jail because of it. But it was fraud. It was mortgage fraud that was committed. So.
And what exactly did, what's the guy that got crushed? Bernie
Madoff?
Yeah.
Mm-hmm.
Like, do you
The
know
Ponzi
what?
schemes?
Yeah.
Right.
That was that with the mortgages and the loans.
No, that was more of I think long-term investments. Basically,
Okay.
they were, and he was in a situation. Basically, the Ponzi scheme is the following, right? It's somebody that comes up with the idea, brings in as much investors as they can, and then gives them returns that are usually astronomical or higher than what they can get anywhere else. So again, even people with caution, rather than taking their money and sitting back and going, could this be real? When everybody else is doing it, and especially when he had a lot of high celebs on his list that invested with him, and people have the tendency in human nature, right, to follow the crowds without questioning, right? Would you agree with that?
I would,
Yeah.
and he seems to be the only one that could pull it off as long as he did.
He
Pulled that one off for a long time.
He did, didn't he?
Yeah.
Well, I think basically all you're doing is taking somebody's money, right? You're saying you're going to get back returns. He's funneling his own money, or his own lifestyle is being paid out of these people's money, and as long as he keeps making the returns, nobody's asking any questions, right?
So he's throwing a couple dollars here to keep it because they're asking for the money. So he's throwing just enough to like keep them calm.
So
and then keep
for an
moving.
example, right?
Yeah.
If the market's paying 8% on a retirement fund, again, I'm not a financial advisor, but again, being in the industry and finance, this is basically how it boiled down to. If the market right now on the average is paying 8%, and you give Bernie Madoff's company the same amount of money or whatever the case, and he's paying you out 12%, obviously they're telling their friends. He's going after the high net worth individuals, celebs, millionaires, billionaires, whoever they can get to bring in money. And as long as he has enough money in that account to pay out that percentage every month, nobody's actually, then the statements show that they have their initial investment still in that account, when all actuality, he's taking that investment and
buying a plane,
buying planes and trains and automobiles, right?
I guess so. Like the average is 8%. He's offering 12.
Right.
He gets one heavy hitter. He's on
All
course.
of a sudden, he's in with his friends and so on and so forth. So as long as he's covering that percentage, but the problem is his account's dwindling. So to only keep the train moving, right, he has to get more people to invest because he needs new money to pay out the old money.
And pay for his own bills,
And
too,
pay for his own bills.
Yeah,
I think he
yeah.
was worth, I forget the number that it was.
It was so crazy.
I think it was a $52 billion Ponzi scheme,
Yeah.
which is absolutely unbelievable.
And he did it like 20 years, didn't he?
He did it for a long time. Yeah, I don't understand how or what the case may be.
I
but
can't think of anybody even close to him that pulled it off. Can you?
No, I know there's a bunch of them that started popping up as soon as he got busted, but
But they lasted like 3-4 years. He lasted
He did it a
almost 2
long
decades.
time. Right,
Yeah.
right.
And his wife she's still living good. I mean, so
I guess would assume, I'm sure, unfortunately, that people's money. I know a lot of people that got hit. A lot of friends of the family actually got hit
from him.
Yeah, it's sad. It's really sad.
Lost
People don't do the
everything,
right
right?
thing. Yeah.
Yeah.
So some people can call it that people say all the time that they knew what they were getting into. Did you really? You assume that stuff's being watched, but.
See, I'm with you. I'm with you on that one too, because a lot of times people say, well, like let's just say I dealt with him and you dealt with him, right? Well, on paper, all looks right, and then you take it to 3 different lawyers. Yeah, this looks good. And then he's got the thing to show for it. He's rolling up in a Bentley or he's rolling up in whatever.
His track record, right?
Right, and he's got the mansion, so you think, well, this has got to be okay.
Right.
And you're trying to get the best that you can get, and then when you do that, you don't realize what you're getting into. And I don't really think if he pulled it off for 20 years, I don't know that anybody would have been able to pick up that. You know what I mean?
You know what it is, as well as, like I said, when he was making the celebrities his clients, when he was making the sports stars his clients, the big heavy hitters, like I said, the millionaires and the billionaires, everybody follows suit because they think, okay, well, if they're doing it, they should already probably did their due diligence. It's okay, right?
Right.
It's following the herd.
And now you feel privileged to even be able to work with him
right.
at 12% while he's taking you to the cleaners, pretty much.
Well, he's taking it out the back door, exactly.
Okay, so you get into absolute home mortgage,
mm-hmm.
okay, and then you start building up.
Right.
Now, what do you have to do to build up to the point where you're at now? Like, not where you're at now, but just you get in there, you're dealing with the banks and everything else.
So the change in the business really kind of started to take a little bit of a turn in around 2010, 2011. Like I said, when I got in the business, we were kind of what we call a refinance shop. It's basically an office where you're dealing with people over the phone and you're constantly dealing with solely refinances. So we sat back, every year we look at the market, we kind of figure out a new business plan, and we started seeing that purchases were starting to come back. And my partner, he, like I said, has been in the business for quite some time, and he was coming out and saying, guys, we need to start going after and getting involved in the purchase market. It's coming back. So we had to go out and build basically referrals in our network referrals, basically realtors, accountants, attorneys, things like that. You'd go out, speak to them to work with their clients, tell them what you do, build the relationships, and obviously get referrals from any buyers that they're working with. So we went from a refinance shop, which we were doing 100% of refinances, no purchases, to now we're, I would say, 90 to 10 purchases compared to refinances.
So you go from the refinancing to purchases.
Correct.
Like purchasing homes.
Purchasing homes,
like that,
dealing with
right?
Buyers that are actually out there, their families that are purchasing the home, correct.
And what made that turnaround, though? Like it went from 2008, where everything was a nightmare, things were bad.
Interest rates definitely had a deciding factor with it, right? So people refinance for certain reasons. It's either you're lowering your payment, you're taking a lower interest rate, or you're using the equity in your property to pay off debt consolidation, credit cards, things like that. So our business kind of is kind of like a roller coaster. Interest rates are extremely low. Everybody refinances, takes advantage of the lower rates. When values continue to go up, usually interest rates follow. So interest rates would creep up as well. Now people that again, are out there abusing the credit cards. Credit cards are what, 23, 29%?
Yeah.
So if you keep a balance on them. So what happens is people always get themselves in trouble with credit cards. So if somebody has a $30,000 debt on their credit card, for example, and I'm able to help them by paying that debt off with equity from their home and say get them into 3% in today's market, for example, who's got it better than them, right? You're still saving them a huge amount of opportunity. They're getting their net tangible benefit to be able to close the loan, and they're saving money every month.
So now I wanted to ask you this, and my accountant's going to love that I asked you this.
Sure.
So why is this? So if I have a credit card with $50K limit on it, right,
mm-hmm.
and I use it, right, and I put $30,000 on it, I buy something, but then I pay it,
right? Why
does my credit score go down, even though I'm paying it?
You know what? That's one of the biggest questions everybody asks.
You get that asked a lot?
All the time. And again, I wouldn't call myself an expert, but I've seen a lot of different credit scenarios, and here's basically how the credit algorithms for FICOs, for Experian, TransUnion, and Equifax actually
more
work.
algorithms.
Yeah, exactly.
More algorithms.
Yeah.
Just what I need to hear.
Right. So the biggest question that most people say, right, when say you go on your credit card, Capital One, CreditWise, Credit Karma is a big one. Everybody can go on there and everybody wants to watch their credit. Today's market, credit is such a huge thing in people's lifestyles. Your car insurance is affected by your credit score. Did you know that?
Nah.
Yeah. So car companies, when you go for insurance, they pull your credit. They don't typically tell you. Sometimes they do, sometimes they don't. But it's affected by your credit score. So how they actually determine the consumer that they're doing business with is off of people's credit scores, right?
You hear
It's
this,
actually
Rob?
pretty smart.
Your car insurance?
Yeah, car
Okay,
insurance
okay.
I've seen for examples.
So explain that to me again. Your car insurance affects your credit score?
No, other way around.
Oh,
Your
I'm
credit
sorry.
score, in a lot of instances, a lot of the big insurance companies out there are determining
I see.
and basically placing you as a consumer based off of your credit score.
Wow.
You know
Yes.
that? You go try to rent a car.
Holy
If
shit.
you're some people have to leave deposits, some people don't, right?
Yeah.
It's off their credit scores.
Wow.
Right. It's
Wow.
amazing.
Yeah. I didn't know I didn't know that.
Not many people do, to be honest with you. The biggest question that we have is great. What affects my credit score the most? How can I get my credit score up? And why does Credit Karma and these other sites that I'm using come up with different scores than you do? Right? So for mortgages, we pull what's called an integrated credit score. It's basically, it looks at a lot more than just your balances in what you have on your credit cards in comparison to a lot of other things. So the integrated side of it, say for example, how do you really understand a person's spending habits? Right? Your car payment's typically your car payment every month. Your mortgage is your mortgage payment every month, right? It doesn't really change unless there's some type of variable there. The only way you can see somebody's consumer spending habits, you put a female in the mall, you give her $1,000 credit card, and you see what she comes back with, right?
Yeah.
Most of the time it's gonna come back maxed out. Exactly. So what happens is, okay, great. Now somebody has $1,000 limit on their credit card, and they're carrying a $990 balance. Okay, a lot of people as well. What happens? You get a $25 minimum payment. If they make that minimum payment all the time, in the algorithm, it makes them look like a little bit of a hindrance because they're making the minimum payment on a bigger balance that they owe. So a lot of people that pay down their credit cards every month, there's another misconception there, is people think that because they pay their credit card to zero balance all the time, that they should have great credit. I would have to agree with them in most instances. But what happens is a lot of the time, say you run up $500, $1,000 on your American Express, you pay it to zero at the end of the month, American Express reports back to the bureaus because they only typically do it every 30 days or 45 days.
Mm-hmm.
So when they report back, it's shown that you're not utilizing your credit. So it's a sticky
It's
game
like
when
a
it comes.
catch-21, right?
Yeah, absolutely. It's if you don't use it, you lose it. If you do use it too much, you lose it. So like, what's the happy medium there? So typically, we always want to keep your balances below at least a 30%. A lot of the times, because we also do help people in the system on some consultation. Now, again, I'm not in credit repair, but if somebody comes to me and I look over a credit report, I can give them some pointers how to get their scores up pretty quickly. And it's always due with the balances on your credit card in comparison to the limit that you have on the credit card.
So the ideal thing to keep your credit like level, you would
Mhm.
say is if you have a $10,000 credit card balance, right?
Sure.
Keep $3K on there.
I wouldn't even go that high, to be honest with you, to have your scores increase quite a bit. Use it, and then drop it down to like $100. Keep something on there revolving that shows that you have. Because think about this, right? You go out there and one of your friends tries to borrow money, but you also know that he owes every one of your other friends money. Are you gonna loan that guy some $100?
Absolutely not.
Exactly. So it's the same thing when somebody goes to get an inquiry for a new credit card, right? They reach out and say, okay, they go to Visa or Macy's, for example. I'm gonna get a credit card to open up credit. They pull the credit balances and things like that, and they shows that they are maxed out on every other credit card that they own. You're probably not going to release credit to that person because their credit scores are low, and they don't have a lot of credit available to them. They're not a responsible spending consumer.
So what's like what's the percentage that you would recommend, just from your experience? Not that you're right or wrong, just in your opinion.
Yeah.
What percentage would you say for somebody that, because everybody I know, and I'm sure you know too, they all use credit, especially if they have American Express, because they
Sure.
get rewards
Points
and all that other stuff.
Right.
What would you say is a good percentage to keep on that card?
The rule of thumb is what they say is 30%. What I see when I do a consultation.
You're dealing with it on paper.
Yeah, when I look over somebody, for an example, I have a client, I look at their credit and I give a consultation on it. A lot of the times we see potential score increases through some of the simulators and things like that we have, proprietary software, that'll tell us $10. Pay a $5,000 if they have a $500 limit on something. It's $1,000 credit limit, and they have a $500 balance. To pay that down to $10, and we see 30, 40 points jump. I've had
Really?
clients where I've given consultation. I've gotten their scores up 70 points.
So it's almost like just 10% keep on that.
I would recommend if you can keep it
From
under
what
10%.
you've seen.
Absolutely.
Wow.
Yeah. Like I said, there's some misconceptions there, and it really depends on who you speak to, right? Everybody always comes back with bad advice. A lot of times I've had people tell me, well, my neighbor told me to do this for my credit score to increase. Well, no offense, but what does your neighbor do? Oh, he's a plumber. So you're listening to the plumber, and it tells you maybe he's had a past experience, but...
Yeah, but, but it's amazing, right? You would think, just like as a human being,
Sure.
right? You would think, okay, if I get this card and I got 50K on it, and I
Right.
run up all 50K and I pay it all off,
Right.
that my score would go up.
Right.
But I've seen it happen. My friends have seen it happen. You pay it off and you just get crushed.
Yeah.
Or actually, how often does TransUnion and Equifax check that?
That's a great question as well. So each creditor, believe it or not, so when you use your credit card, right, on the way here, I stopped and had to get gas. If I pulled my credit prior to basically putting any charge of gas on that credit card, they only report every, say, 30 to 45 days. Each account or creditor, they only report on their own, however, whatever their terms are. So sometimes it's every 30 days, sometimes it's every 45 days after the statement ends. So sometimes you have to call and find out because there's no real right or wrong with that. It's really whatever their turn times are for that card. But for example, if you go spend $1,000 on your credit card tonight and you pull your credit tomorrow, that $1,000 isn't going to be reported. There's not live communication between the bureaus and the creditors. Does that make sense?
Yeah. So in other words, you have the timing down.
So in an aspect, or we always have to find out when it is. Like I said, we work sometimes hand in hand with the companies that we pull credit through that assist us and can kind of do what's called rapid rescores, for example, and say, hey, if this client pays down X, Y, and Z, and they provide the information of doing so, we can submit it to the bureaus on a faster aspect, typically about 3 to 5 business days, and it'll return with what's called a rapid rescore. And that can get their scores up, which, again, your interest rates, your terms, your approvals, everything's based on credit these days, man.
But now if you would have went to that gas station at the wrong time when they were pulling it, right, and used your card, it would have went down.
It could have. If I used it and I didn't pay it off and my balance went higher than what it was the month before, typically your score will decrease.
What a mess.
It's tricky, man. It's tricky.
A whole mess.
Yeah.
And then what do you got? Equifax, TransUnion, Experian.
Those are the 3 main.
What's the
FICO
one
scores.
that most of a guy in your industry pays attention to? I know you average it out, right?
Yeah. So for example, if you go to get a car loan, they typically only pull 1 score for you, or they'll pull 3 and they only use 1. What we do from a mortgage standpoint or a banking standpoint, we use the middle score. So we'll pull all 3, and we'll use the middle score of whatever one. So say you had a 600, a 700, and a 720. We would use the 700 to qualify you.
Okay.
Now your next question is going to be, why is it variance, right?
Yeah.
So each bureau, right, has their own algorithm on what they actually look at. Not to make it more tricky. Then you have certain credit card companies or creditors that only report to certain bureaus. So people have, for example, somebody goes to the hospital, has health insurance, and all of a sudden a doctor walked in, shook their hand. They got a bill they'd maybe misplaced it or never received one, and they get a collection. It goes to a collection company, right? That collection company sometimes only reports to one bureau. So say they only report to Equifax, for example, and then I go ahead and pull it to qualify you for a home loan, and all of a sudden you have when you say your Equifax is a 600, but your other scores are near 7, and you're like, hey, what the hell's going on here, right? It's because that collection only is reporting to that bureau, and it's a derogatory effect to your scores.
So do you think they pick the worst one to report it to, or they're just lazy?
It all depends on because it costs them money to report typically as well. So it all depends on whoever they're set up with. Some report to all 3,
so
some report to only
they
a
have
certain
to pay
one.
to report that?
Yeah, typically.
Wow, really?
Because again, that helps them get paid, right? If they report that if they don't report that to anybody, are you ever going to go pay them?
Right.
Probably not.
No.
If I call you, if you come to apply for a home loan, I say, hey, if you have to go pay this off to get 30 points to get you approved, they're like, okay, we've been waiting for you.
That's interesting because you would think that they would report it to all of them.
Some of them do, but I have seen in the past that they only report to 1, sometimes 2. So it kind of help. It could help the consumer just because all their scores don't go down, but it can hurt them as well.
What do you think of credit wise? I ask that because I like credit-wise, but
Yeah, no, I use it personally. Believe me.
do you really?
Yeah, but like I was saying before, people use CreditWise or Credit Karma. It's good for what it's there for, right? It's a different score than what we have because when we look at it from banking again, it's integrated, so it goes a little bit deeper into the consumer's spending habits. Like I mentioned, if CreditWise isn't going to pick up on if you made $100 payment last month and then you went back to the minimum payments on your credit cards, whereas we recognize that on an integrated FICO score.
So credit-wise, they pretty much just average the 3 or 4 of them together, and then that's what you have. Is that how they work? I mean, they're owned by Capital One, though, right?
I don't know if they're owned by Capital One
Or they're in cahoots.
Yeah,
Somehow, some way.
there's a
with
relationship
Capital One.
there that Capital One utilizes them for their clients. I don't know if there's any ownership or not, but typically they'll pull. Here's another thing that's tricky.
Yeah.
Is everybody heard of FICO score, right?
Yeah. Well, tell me what a FICO score is.
So FICO score is basically the company or the algorithms that are used, right? That they utilize.
These algorithms.
I'm telling you, man, it'll make steam come out of your ears.
I already have. I've had it come out of my ears for the last 10 years. Now it's just coming out even more.
Right. So what happens is FICO. There's different types of FICO scores that are pulled. There's 8.0s. There's 9. Like I said, we typically pull a 10, 10.2, I believe. But it all depends on what the algorithms place weight on to determine the scores. So.
And what is a FICO score again? Like you say, 10.2.
It's the algorithms that they utilize, right? It's how they determine the score. So it's like their formulas, and they upgrade their formulas in some instances. So there's a couple of them out there. Like if you go get your credit pulled for to purchase a car, you're gonna have a different credit score than when I pull it for a mortgage finance.
Really?
Yeah.
Wow.
When people go on CreditWise, it says on the bottom either reported by Equifax or Experian. I forget which one it is, but when I pull it, it's gonna be a different score. It's because it's the algorithm that the bureaus use to provide information to creditors like ourselves.
I invested in a credit repair company.
Okay.
Now, when you're looking at like a loan to get a house or,
Yep.
Obviously with you a house or whatever it may be, how much into consideration do you take like the medical bill?
That's a great question. So most people, well, I would say, if you've been in that business, how many credit reports have you pulled that somebody has some type of medical collection?
Probably, I would say 80%.
80%. A lot of the times, I've been to the hospital before, and a long time ago, had a collection pop up. I didn't even know where it came from. Dug into it, and it's like, oh, the doctor's office that wasn't part of the hospital when I had health insurance sent this bill and never received a bill.
Yeah.
But you get a collection about it because the guy came in and shook your hand and introduced himself, right? So, yeah, everybody, honestly, 80% I would have to agree, probably have medical bills of some sort in collections. Now, we don't look at those as much as other type of collections. Like, say, for example, typically under $2,000 of medical collections, we don't have to actually do much with. It will affect your credit score itself.
Overall,
yeah, your FICO scores or your 3 credit bureau scores. But from a lending standpoint, if it gets over to a certain point, then we have to take in consideration that into basically to your what's called debt to income ratio.
I see.
So it does conflict. It's all based on per situation too.
And they're easy to get off credit scores. So contact Jesse. Jesse will contact me,
Okay.
and I'll talk with my guy, and then
There you go.
he'll get it off.
There you go.
Yeah, they're easy to get off.
Yeah.
So what is the hardest thing to get off on a credit score? So like when somebody comes to you and I've actually come to you. I know how good you are. I mean, you're a monster.
I appreciate that.
No, I mean that with respect. But when somebody has something on the credit that just has them stuck at say 650, but you need them at 680.
Right.
What, is it credit card? Is that what it always
That's the
seems
biggest
to
thing.
be?
It's people's credit card debt because I hate to say it, but it's America, right? Everybody has a credit card typically, and everybody either uses it or abuses it.
Yeah.
Or both, right? So a lot of the normal consumer is always having some type of credit card debt following them, and they'll get in over their head. Everybody has the best intentions, right? We're gonna go on a family vacation. We're gonna run up $3,000, and we're gonna pay it off next month with my bonus. Well, that bonus comes along, and then all of a sudden, there's a lot of cooler stuff to be spending the money on. So you don't pay it down, and then you get stuck just chasing your tail because of the interest rates on it.
Right. They're like, okay, well, instead of paying that, let's go to Ruth Chris tonight,
Exactly.
or the Gardens Mall,
Exactly.
or whatever.
Right.
Okay, so now you get into all this. You're with Absolute forever, and then I read that you educate your buyers.
Sure.
And not many people say that. You know what I mean? I went to buy a couple houses, and believe me, there was no education there. It was like, do you have it or do you not have it?
Right. You're approved or you're not.
Right.
And that's really one of the main things that I do take to heart, because it's a great feeling putting somebody and a family into a home on closing day.
But you're a human being. You know what I mean? Like, we've all been there, you know, and maybe we, ramped the credit card too much or spent too much or whatever.
Sure.
But every time I've gone, other than Wall Street, Gary, and you, and the crazy lawyer that goes and watches traffic court, you know what I'm talking about?
Which one?
Gary took me to this lawyer, and he went in, and there was like a bunch of things we had to do. And I said, "Where are you going?" He goes, "Wow." Timmy, older guy.
Could be.
Interesting story. He goes.
It's a great guy.
His therapy, right? Like, it's not a therapist. He goes and sits in the back, like a chair like this, and just like it amuses him. Traffic court. He actually sits
their own, right?
I said, "You got to be shit, man. There's no way you're." He's no. This what calms me down. I have to go home. I have to go home to my wife. I got to deal with a bunch of shit. This is what and he'll go there 3 times a week just to watch people getting like hit with tickets. It's like his thing, but he's a killer.
That's
lawyer
practice.
for
He
that.
probably sees what works and what doesn't work, if you think about it.
Yeah, he's like, "Come back in 2 days." I'm like, "There's no way you can do this." I came back in 2 days. Went to traffic court for 2 days. I said, "Why don't you go to traffic court some more?"
Right.
You know what I mean? But yeah, I mean, they usually don't educate the buyer. So when somebody comes to you and they're not where they need to be, how do you educate them?
Well, here's what I look at, right? And this is why, again, I always want to, when I'm out there meeting new people, so on and so forth, I deal with a lot of realtors in an aspect. We have, those are my referral partners, like I said, CPAs, which is certified public accountants, attorneys, divorce attorneys, believe it or not, are good referral partners, just because somebody's going through divorce. Typically, they're buying new houses. But when it actually
who's buying a new house?
Depends on which side of the fence
the
you're
lawyer
on.
or which one?
Yeah, it depends on which side of the fence in the divorce, right?
$10K for a paragraph. Yeah.
But no, when a consumer comes to me, like I said, this isn't something that everybody does every day. Right now, there's some investors that this is what they do, and they flip houses. Those are my clients as well, but they're a little bit more savvy when it comes to the finance side. But the normal homeowner, what would you say most people purchase a home? Every purchase or refinance the average is typically about every 5 years. They do something with a mortgage if they're a homeowner. So when people come to me to purchase, again, they could have bought a house 2, 3, 4, 5 years ago. I always tell realtors that refer me a client, for example. I said, you guys are the lucky ones, right? You're the one that gets to go out there and do the shopping with them. Everybody wants to go shop. Everybody wants to go see houses. It's fun to plan what color we're going to paint the bedrooms. Is this house big enough? Does it have a pool? They get referred to me. I compare myself to the dentist in a nice way, just because, again, I'm the one asking you about your finances. Hey, this deposit in your bank account, what happened? Where'd it come from? They're like, it doesn't matter. It's my money. And I'm like, I agree. I'm with you. But unfortunately, this is stuff that I like to do up front. So a lot of people try to put the cart before the horse. Everybody wants to go shop for a house before they get their finances straight, which most realtors that have been doing this a long time will require you to get pre-approved, just because they don't want to be showing you $500,000 houses if you only qualify for $200,000. Or if you want a $500,000 house, you don't think you can afford it, they're going to show you $200,000. You're not going to be happy. So you always want to look at your finances, make sure that the numbers you're comfortable with, make sure you can afford it, so you're not putting yourself in a bad position. But when I say educating my clients, for example, right, it's basically saying, hey, I want to look over everything up front. And there's another thing. I, as a senior loan officer, I compare myself let me be your attorney, right? And then the underwriter's like the judge, right? So I need to make sure that all your paperwork and everything is in line before I submit it to the judge for approval. So educating them, basically, if their credit scores need to get up, or give them a consultation on their credit, on their monthly payments, educating on what to do and what not to do. For example, a lot of people have cash in today's world, right? Well, if you put cash into your bank account, we have to source all your funds, because these are government-backed loans. So they want to know where the money came from due to tax purposes, so on and so forth. So to educate them, there's certain things that we don't want to see on your bank statement, and there's certain things that, for example, people get commissions, or how they get paid at work, or being self-employed. There's a lot of moving parts in the actual aspect that if you come to me first, say 60 days, 30 days before you're looking to purchase something, it could be smooth sailing. The people that go out there and find the house and then want to go get their finances straight, that's where it turns into a little bit of a whirlwind.
Then you're like the guy with the horns, right? because you have the real estate agent saying, "Oh yeah, well, yeah, we can get you this. Well, here's Jesse." Now Jesse comes along and he says, "Well, I hate to break this to you, but
Yeah, we're the
you
bad
have to
guys
do A,
sometimes.
B, C, D,
Right.
and unlike other lenders that I've ran into,
Mhm.
that's why I kept asking you for 2 months to come in. You know what I mean? Was because and I've seen you do it with a couple friends of mine.
Right.
You need to do A, B, C, D, E,
Mhm.
and then I can get you there because just like you said, like a lawyer.
Sure.
Look, you have to sign over this. You have to give them
Right.
this much money.
Right.
You're going to have to plead to this to get this.
Right.
Right? Kind of like
Right.
the same type of synopsis in a way.
Yeah, you have to follow certain steps, right, to make your life that much easier to get what you want, right? It's preparation. And
Yeah.
it's not like the clients, I'm not dealing with somebody that's going out or financing their first car, or the consumer themselves or the buyer is not buying some furniture. You're buying a homestead. You're buying one of the biggest investments that you're going to probably purchase in a lifetime. It's up there, right? You're not talking about buying a house for 20 grand anymore. You're a couple $100,000 and up. So these are things that you want to be prepared for. You want to be in the best position with your best foot forward when you get qualified, because this is long-term financing, right? Most loans that we write today are 15, 20, or 30-year fixed loans. So if I can catch something up front and say, hey, do X, Y, and Z to put you in a better position, it just helps.
I never quite understood that. So you have a fixed loan, and then
Mhm.
what do you have, a variable loan? Or
To be honest with you, those options are still out there, and a lot of times there's a lot of hearsay, right? Everybody sits there and goes, okay, well, this is an adjustable, or this is a fixed loan.
adjustable. That's
Adjustable
what
rate.
I'm looking for,
Yeah,
right?
an adjustable rate. Which again, if they're used properly, they're great. They're great loan options. If you come to me and say, "Hey, Jesse, I want to buy this house, and I guarantee, I know, within 4 years, I'm going to be out of this loan. And I want to upgrade, or I'm going to move, or whatever the case may be." Right? What's the best loan that I can get for you? Okay. Well, maybe what's called a 5-1 ARM, which is an adjustable rate mortgage.
What's called a 5-1 ARM?
Yeah, it's called a 5-1, for example, one of the loan products. It's 5-1. So that basically means that for the first 5 years, that interest rate's going to be fixed. But those rates are lower than what you're going to get for a 30-year fixed mortgage. The bank knows that, okay, if I lend this guy this money, I'll guarantee this rate for 5 years. But after that, it's either going to adjust or become due. That's where the balloon comes in.
And would you recommend that, or it just depends on the person?
It depends on the buyer. For
Oh,
example, like
yeah.
I said, if you come to me and say, Jesse, I'm going to be out of this house in 4 years, give me the best loan available, we could look at that option and explain it. Hey, here's the pros for it, here's the cons for it, and then obviously let the consumer make their decision. But in the same token, you get a lower rate, and you're out, and your guarantee means you're going to be out of that in 4 years, then that could be a great loan option for you. It's when it gets abused where, kind of back in the heyday, for example, if we go back to, like I said, the earlier days, 2006, 7, 8, before the crash, a lot of people were utilizing those and putting people into those because that's what they qualified for. But when the interest rate started to adjust, that's when people got themselves in a pinch. And like I said, I've heard that people didn't even know that they were getting into adjustables. When it started to adjust, they realized that their payment jumped $1,400.
Maybe this wasn't such of a good idea, right?
Correct.
Because they had whatever percentage for 5 years, and then after that 5 years, now they can rock them if they want to, or if something goes wrong.
So there's actually restrictions on how much it can go up and go down.
Are they still in place now today?
Adjustable
restrictions?
Yeah. So when you sign up for example, the 5-1 ARM, for example, so you get into it, it's going to be fixed for that interest rate for 5 first years. After that, each year it has the opportunity to adjust, but it can't adjust more than, say, 5 points X or 6 points, whatever the actual requirements of that loan product are. So it can't go, say, from 3% to 20%, but it could go from 3 to 8.
Now, like when I was reading through everything with you, you said a home market curve.
Mm-hmm.
What is that? I have no idea what that means.
So the home market curve, right, for example,
This is like a complete learning lesson for me.
Sure. And
Yeah.
you're using this for personal aspects, aren't you?
I mean, just general knowledge. It's
Yeah.
interesting to know.
Right.
Because you hear, like you said, hearsay you hear all the time.
Right.
But someone who's actually dealing with it day in and day out. And
Yeah.
who's gotten to the point where you got with a nice fitted suit on. I mean,
I took it out of your closet, man. Come on.
Did it?
Thank
you
you.
didn't need to tell me that. I'm just kidding. I wish I was 6'1". Maybe I'm 6'1".
Maybe you are.
Yeah, but so what do you mean by that? So the home market curve.
So the home market curve is in a way is basically just values of the properties. It's property values kind of take curves with what's going on in the economy, right? So for example, right now in today's market, you're seeing here in South Florida that houses are constantly appreciating, right? What's causing that, would you say?
I don't know.
Right.
I'm shocked by it, to be honest with you.
It is pretty amazing, but here's what it's boiling down to in a way. It's really inventory. I have a lot of buyers that are out there pre-approved in the market, and they just can't find the house that they want. Everything is continuing to go up and appreciate, which is really kind of, again, we live in South Florida. It's a desirable area. We're having a lot of more people move down here, especially due to the current situation we're in with the pandemics, right? Everybody wants to get out of the state that they're in. Everybody wants to go to the beach.
Yeah, everybody's down there now. Traffic is terrible.
This type of year, usually when season, though, it does get a little increase, but not.
Yeah, I've only been here 5-6 years, but you've been here forever.
Yeah, since '97. Yeah, a long time. But basically the value market curve is what we're seeing continue of appreciation. Average right now in Palm Beach County is what we're being told is between 3 and 5% appreciating values for properties.
Wow.
So again, it has its slow points. Depends on the area, the zip codes, things like that of the market. But the curve is basically the increase of the appreciating values.
Now, I've heard two ends of the aspect of this, right? Do you think that whoever like right now, Biden's in, and if they can prove he won fairly, I'm fine with it. But
right.
Do you think that whoever wins the presidency will have an effect on this, or do you think this is just the way it is?
Every time around election time, we definitely see a little bit of a shakeup. Interest rates are ones that typically, any time of shakeup, right? I don't care if tomorrow something happens and say there's a global warfare of some sort, right? There's always going to be a shakeup in interest rates and the Fed rates and the 10-year yield bonds and the bond markets. They always, in Wall Street, right? They can always raise rates when uncertainty rather than lower rates. So to be honest with you, I don't have a crystal ball, but per se, yeah, I think it could definitely throw up a little uncertainty in the market. So which way it could go, I really don't know.
I'm just shocked with all the uncertainty that the market is still going up, like in the stock market and the real estate and gold. I mean, well, I understand the gold thing. The gold is going through the roof.
You would think, isn't it? I had a buddy of mine that I haven't watched it recently personally, but he's heavily vested in it, and he said he's getting bent over.
But with gold?
Yeah.
Oh, no,
I don't know if he's in the wrong stocks or whatever it might be, but
yeah, I'm talking like jewelry. So
okay.
like if you bought a like a gold watch,
sure,
4 months ago,
yeah,
it's 30. It's almost double what it was 3 months ago.
Really?
Yeah.
Wow.
Yeah, it's pretty crazy.
That's amazing.
Yeah, I mean,
it's going back to those currencies, maybe. Who knows?
What do you think about like this cryptocurrency thing?
You know what? I don't really know much about it.
But when you look at a bank statement to give a loan,
right,
and you see that a person has been dealing with Bitcoin or Litecoin or Ethereum or whatever,
that's something I would tell them to stop doing right off the bat on that bank statement. Just not from a personal opinion or if they're going to lose or not, but just from a lending standpoint, we can't really source that, so we can't really use it.
Yeah.
So any assets, again, because a big portion of these loans are government-backed loans, right? That's what we call them because they're basically backed by the government, either with mortgage insurance, FHA loans, or government mortgage insurance. Even Fannie Mae and Freddie Mac are basically backed in a way from the government due to the bailouts and things like that. They're a lot more integrated and involved on looking at qualifications. So when somebody comes in and says, hey, I have $30,000 buried under my mattress or buried in my backyard or under my mattress, and they deposit it into the bank account, we can't use it because we can't source it. So that is one thing that if I were to see that on people's bank statements, to answer your question, I would kind of tell them to slow down on doing that or using their bank statement. To answer your question on how I view it, I don't know much about it.
The reason why I asked it because I had a guy in that he doesn't have them. He's in partner with a guy that has 4,000 of the ATM machines.
Okay.
So if you have Bitcoin, you can put like your barcode in.
Okay.
And the percentage is like 20% to get it out. They kill you.
Wow.
And then I have another friend who just sits and lives by this Bitcoin thing.
Is that all the same cryptocurrency, for example? Like, is it 20% for Bitcoin? And I know there's another one. Do they charge the same?
Well, like Bitcoin, I think there's a little bit of variation, but it's like 10 to 20% to take it out of an ATM. So if you go there and you scan your SKU code at the ATM, you can get cash out.
Right.
But they're going to knock your head off.
Right.
Especially like right now, the big one's Bitcoin.
Right.
But in my opinion, not you saying this, it's me, once they realize that the whole damn thing's manipulated, you don't even know who invented it. I mean, that's just my opinion.
Yeah. So if you're asking my personal opinion,
yeah,
like I said, I don't know much about it. It's not something that I can touch. I can feel.
I've never bought any of it.
It's I think it's all based on hope, right? It's based on hope because somebody believes that it's worth something.
Right. So to me, like when it went up from it used to be like $39 coin.
Okay.
Then it went to like 4K a coin.
Right.
Then all of a sudden out of nowhere it went to 25K, right? And it stayed like that for a month.
Yeah.
Now people were taking out their investments, their student loan, or not student loans, like whatever they had saved.
401ks.
401ks, things like
their
that.
hands on to
right.
get involved.
And then bang.
Right.
If you didn't sell right away, you're dead. You just lost everything.
Right.
You know, so to me, it's manipulated. Now, you don't say that because you're in this industry. I'm saying it's manipulated as can be.
I guess you could relate that to, per se, the Ponzi schemes, right?
To me, it is.
People believe that has that much value because, you know, if everybody's doing it too, like you just mentioned, people that were coming out of the woodworks that never invest in the market. That's one of the scariest things is when those type of people, or the normal consumer, it's terrible to say, but the normal consumer gets involved because they hear the hearsay, and all of a sudden they're the ones getting on the backside of it, and then they buy in, and then all of a sudden it tanks, and they're like, well, what happened?
Because they don't think it through, right? So if something goes from $39 to 4K, okay, that's possible.
Right.
But then in 2 weeks it goes from 4,500 to 25K.
Right.
I mean, to me, and I'm sure to you, that looks like manipulation right away.
It's hard to
because
make
what is going to make
it
go up that quick? But
right.
then, like you said, you hear your friend, this guy, oh, I'm buying. Oh, well, now if I buy this, maybe it's going to go up to 50K.
Right.
And then I could buy a house, I could buy a car, I could buy whatever.
Bitcoin must have came up with a cure for cancer then, didn't it?
Yeah, I mean, better have some really good stuff, right?
Sure.
And then, the people behind Bitcoin who we don't quite know who it is.
Right.
Or we don't think we know who it is. Then they let everybody buy, and they lose. They lose, tens of millions or whatever. But the people that held on to it, that put their life savings into it, is the ones that got killed because then it went from 25 back down to 4.
Right. And everyone's holding the bag, asking what happened.
And now you're not going to recuperate from that. And now we'll shoot up to 10, back down to 4. But what about the 25K?
Right.
You know what I mean?
What drove that market?
Right. And then, and I'm sure before you used to be able to buy Bitcoin with a credit card. Like Chase stopped that right away.
Yeah.
Chase, Bank of America, Wells Fargo, nickel and dime you to death. If you deal with them, don't even reply to that. But they nickel and dime you if you take a jaywalk.
Right.
But, the banks started banning it. And the point of all this is, why do you think that the government hasn't gotten into it?
Well, again,
or to make it like a what do you call it, FDIC?
A currency? Yeah, an actual like approved currency.
And make money off the damn
Sure.
thing.
So, again, I might be speaking totally out of my wrong side of my mouth because I don't know that much about it. But my concern was, and I never got involved with it, is it taxed? It's kind of like a black market currency, right?
Yeah.
And then I heard that PayPal is going to start being accepting it or something. I don't know if that's true or not. Did you hear that?
I heard it, but eBay is owned by, or PayPal and eBay. Well, actually, what happened is that
Elon Musk came up with PayPal, didn't he? And he sold it to eBay.
No, I could be wrong. From I'm just telling you what I know is that eBay was eBay, and then they had PayPal, and you really had a tough time using eBay without PayPal.
Right.
Then the government comes in and says, "Hey, this is a monopoly," right?
Okay.
So now I go to you, Jesse, and I say, "Hey, Jesse, put this under your name, but give me 65%."
Okay.
And then that creates a non-monopoly, but it still is. Just like Google is, Google is WhatsApp, Instagram, Facebook. They're all connected into one. It's like umbrella after umbrella after umbrella after umbrella.
Shell company, shell corporations.
Yeah, Shell, yeah. Mm-hmm. But when you see that on a bank statement when going for a loan, you just are like, no, we're not.
I would advise against it just because we don't have the sourceability. We have to be able to source where those funds came from, and I don't know where it came from. You know what I mean? It could have came from the black market of some aspect, but I don't think it's taxable, right? So
right now it's not taxed.
So so say for example, Walmart starts accepting Bitcoin, right? How does the government allow that?
That's why I'm asking you. I don't know.
I'm right there with you. I don't have those answers either, just because I don't know how. Like
They
I said,
were for a minute, and
Really?
and then the banks cracked down. They were like, or the feds or whoever it was, and then they were like, no, and then
it's an untraceable currency, right? So
Yeah.
how, if you can't trace it, how do you tax it? That's where I really think it comes in.
I'm just shocked that at this point that the government has come out with their own cryptocurrency,
I
like
agree.
not called Bitcoin, like called GovCoin.
Right.
You know what I mean? And then
Right.
tax it like you would anything else.
Or
you
turn
know?
the dollar into it. If you think about it,
Right.
we're pretty close to being there, right? When's the last time you really? How many people really carry cash anymore these days?
Yeah.
You know what I mean? It's sad in a way, but everything's off a credit card. You get your paychecks, they want you to direct deposit, right? So all you're doing is transferring numbers, and that's what it looks like to me in a bank statement.
So that's the Bitcoin thing. So yeah, we could go on
Yeah,
because
exactly.
I don't understand it any more than
I'm with
you.
you. I'm with you.
I've always stayed away from it. A friend of mine did make a shit ton though.
Oh,
He
sure.
bought it when it was he bought it maybe 8 years ago, and it might have been 39 cents a share. But as soon as it he had gotten a trust fund. He finished school and then he got a trust fund, and he made like $8 million. But as soon as he saw it go up, shut up, yeah, he made $8 million,
Wow.
8.7 million.
Wow.
But he didn't wait. As soon as he saw it shoot up, boom, he was gone.
Yeah.
I mean that was it.
I would agree.
Now he just watches Bloomberg all day.
It's
You know.
a tough life too, man.
Now you were talking about in your bio, and as I was reading up in your FHA, VA, like what's the difference between all of that?
That's a great question. So FHA it's basically a government-backed loan, like I was mentioning kind of before. So you have what's called your conventional loan programs, which are normally a lot of people have the misconception of the loan that you have to put 20% down for. It's not the case. You can put as low as 3% down with first-time homebuyer programs.
Wait, no, hold on, Jesse. I've heard that before. That you can put 3% down on a house.
You can purchase homes with.
So if I buy a house for $1 million, I can put 3% down.
All right. So there's limitations and guidelines.
Well, that's why
right?
I'm throwing that at you.
Sure,
To explain it to
sure.
me. You know
So
what I mean?
the different types
Thank
of
you.
loan programs is there's conventional loan programs, there's FHA loans, there's VA loans, and then there's USDA loans. Those are typically the main government-backed loans programs that are out there. Now, those are the ones you're getting the best interest rates with. Those are the ones you're going through a full underwrite, what are called full document underwrites. There's not stated or bank statement programs, things like that. They're basically looking at your income for two. So just to give you a quick rundown, right?
Yeah.
When I say you're a borrower, you come to Jesse, hey, I want to go ahead and get pre-approved for purchasing a home. Okay, great. We call it ICE, I-C-E.
What's that stand for?
Very simple and keep it in a nutshell. So ICE. We look at 2-year work history of the borrower, basically where they work, how much they make, how they get paid, if it's W-2, commissions, bonuses, salary, all the above, right? That's for income. So 2-year work history and how much you're currently making. C is your credit, not only your credit scores, but any revolving debts that you have, car payments, student loans, credit cards, anything that shows up on the actual credit report. And then also your credit score as well, along with your debts. And then E is your equity position or the amount of down payment that you're putting. So like I said, for conventional loans, for example, I have as low as 3% for first-time home buyers. 3% down of your purchase price.
And what do you need to qualify to get that?
So
That would be intriguing. If you say the right thing right now, you might get a lot of calls.
to be honest with you, it's the same as any other loan program. So again, we make sure that your credit scores typically to a certain standard.
And not to interrupt you, I'm sorry.
No worries.
But what's like a good credit score in your business right now as we talk today?
What's considered kind of A paper is 740 and above.
Damn.
For good credit, it's basically 680 and above. And then we can go all the way down to they did after COVID started, they did kind of make some tweaking to most guidelines and most investors and secondary market of what their minimum scores are. It's typically around 620. But FHA you typically goes down to 580 in most instances as well.
So if I walk in with 620, I'm not getting 3% down, right?
You can go with an FHA loan with 3.5% down.
Get the hell out of here, really?
Right. So again, the reason that is an FHA loan is a government-backed loan. So it meets X, Y, and Z guidelines. The government puts an insurance policy on that loan. So that if it goes bad, it's called PMI, private mortgage insurance. So basically, it is a monthly payment that's included with your actual mortgage payment. So in your mortgage payment for an FHA loan, you're paying your principal and interest, your homeowner's insurance on the monthly proration, your tax proration, whatever it is annually, broken down over 12 months, and your PMI, private mortgage insurance. It's an insurance policy that basically insures the bank that if that loan goes bad and goes upside down, that they don't lose any money on it.
So somebody can walk into you or call you with 620 and get 3% down on a $500,000 house.
So that's another thing. With FHA, they have county loan limits. So, for example, in Palm Beach County, it's $373,000 right now. And some
Okay, so
change.
I could buy a house for $300,000 right now
With an FHA loan with 3.5%
with an FHA
down.
loan with 620. Do you have that on your website?
Absolutely, yeah. It's on there.
Rob,
with
can
the,
you pull up his website?
It's on there with the mortgage guidelines. I don't know if they actually spell out the guidelines themselves, but there's the mortgage calculators on there. And again, giving me a call and getting a consultation, going over the scenario, absolutely. You can go with a conventional loan up to $510,400 right now in Palm Beach County with 3% down, as long as, again, your debt to income ratios qualify, your credit scores, so on and so forth.
And what do they like to see with the debt to income ratio?
So again, it goes off of these days of the strength of the file. So we run it through some systems to where it'll go ahead and spit out approvals. It basically runs it by Fannie Mae guidelines, FHA guidelines, Freddie Mac guidelines, and it'll give us approved. So the stronger the file is, for example, it does allow us to go a little higher on debt to income ratios. So again, it's all
like more leniency.
They're more lenient. So for an example, a compensating factor would be for somebody that had 12 months reserves after they closed in the bank.
Is it here, Jess?
Yeah, that is actually my personal website. So if you go down to some of the products, fixed mortgages.
I got terrible eyesight. Let's see.
Yep, that one right there, Rob.
Click on it.
Yep. So this gives you kind of like just a quick overview. But for actually loan programs itself, it's really just it's a phone call away. I try to pick up the phone as much as possible. If I have a phone in my pocket, I'm working. I'm not a 9-to-5 guy. So anybody that really wants to touch base or go over a scenario, it's really just as easy. So if you look under the 30-year fixed mortgage qualifications there, refinance up to 95% of your primary home's value, buy a primary residence with as little as 5% down. First-time home buyers for conventional now is 3%, and FHA is 3.5%.
So right now, that's not 5%. That's 3%?
3% for first-time home buyers, yeah.
Wow. You definitely need to get your webmaster on there and change that one, right?
The market, sure. Yeah, we get that updated for sure.
And what's the website right here? Exactly. AbsoluteMortgage.com.
So it's my first initial and my last name. So it's Daberkoe .ahmc loans LOANS.com.
Okay, I'll put that in
I'm
the
sure you
description.
put that on the bottom.
Yeah, well.
Sure, and the contact info. But it's really, like I said, it's worth a phone call. A lot of people right now a lot of people don't know that they qualify. A lot of people are sitting there paying astronomical rents that it's cheaper for some people to buy. And a lot of people don't believe me when I tell them this, but it's cheaper for them to buy than it is for them to rent.
Yeah, no, I agree with that one.
So rent's one thing that we've never really seen go down in today's market, right? If somebody's going to go rent, what are they coming up with? First, last, and security.
Okay, so right there,
That right
if
there.
you want even just a place where you're not going to get eaten by bugs, right there is $5-6 grand, right?
Correct.
You know what I mean?
Sure.
And then you're never going to get that security back,
Right.
Unless you got like a really nice tenant or whatever you call them.
Cleaning crew and everybody else is coming in and fixing
they're taking that. You're
a
never
good
going to see
landlord.
that.
Sure.
Okay, so what is a reverse mortgage?
A reverse mortgage
That I have no idea anything about.
Right. So the reverse mortgage is a great loan product. It is an FHA. It's a government-backed loan. It's another one that has kind of the misconception. So it's for the elderly. It's for over 62 and above. You have to have an age requirement. And what they want to see, it's allowing people, like I said, retired people, grandparents, whatever the case may be, that have equity in their house, but now are living on, say, Social Security or small pensions. So say for somebody that had their house is worth $500,000, and say they only owe $200,000, but they're still making what most people pay, like for mortgages, it's called a forward mortgage. So that pays the bank every month, that's called a forward mortgage. A reverse mortgage is when you're utilizing the equity in your property when you're over 62 to basically allow that equity to pay your mortgage payment. So it makes sure that you have a certain percentage and it goes off your age. But as long as you have a certain amount of equity in your home, you don't have to make a mortgage payment ever.
But if I'm 40, that means
you don't qualify.
Yeah, I don't qualify.
Yeah, you don't qualify because it goes off of life expectancy. So it doesn't work, but it's for the elderly over 62. But it's a great program, again, if it utilized properly. The misconception is people think that all of a sudden the bank owns their home. It's not the case. What it is rather than making a $1,000 mortgage payment to the bank every month in interest, if you have the equity, it goes to the back of the loan. So say somebody owed $100,000 and their house is worth $500,000. The next month they owe $101. 102, 103. So it grows the backside of the loan so that way people that, like I said, people that are retired or elderly that are on fixed Social Security, fixed small pensions when they quit working and leave the workforce, they're not strapped to making the mortgage payment.
That's nice.
So it works in their favor. It's a great loan
and you can
program.
do all that?
We can do that as well.
Damn.
One that's going to blow your mind you touch base on is the VA loan. It's a Veteran Affairs loan.
Yeah.
So it's for veterans that qualify, that have veteran benefits. They finance 100% of the purchase.
Okay, so let's just say I'm a veteran.
Right.
Explain that to me.
So say you want to go buy a $250,000 house and you're a veteran. You qualify for the VA benefits. You can go buy that $250,000 house. We'll finance all $250,000 of it for you. The only thing that you're responsible for is the closing costs and what are called the prepaids at closing.
If you're a VA, if you're a VA guy, you better call Jesse right now.
100%. They're great opportunities. So.
And then there's what, USADA?
USDA. It's for more homes. You have to be in a certain demographic of the state or wherever you're living that are approved for USDA loans, and they also go to 100% financing.
What qualifies a state to be, or an area?
Areas. It's more rural because it's a rural loan. So, for example, for Florida, it's more central Florida, like up by south of Orlando areas where,
like kind of like not such a good area.
Yeah, rural. It's not Palm Beach County, for example.
That's what that kind of loan is.
Yeah, it's for rural industry. So
I like how they letter that. Don't reply to that.
Yeah,
but
exactly.
That's a nice lettering to that.
Sure.
And then I have to ask
the
you,
acronym, right?
Yeah, just instead of saying like if you're not in the greatest spot, maybe.
Well, you know what? For Florida, it's a different aspect, but throughout the other parts of the country, like I said, for example, Michigan, there's a lot of great areas, and it's a great loan for certain areas there it's more desirable places. But for Florida, it's for more of the rural, and there's kind of limited because it's Florida's just, again, it's paradise, right? It's not really rural, so.
That's what's so crazy. Like when I first got down here, you could be living, say, like right here,
right,
and 2 streets down, people are murdering each other left and right.
On the other side of the
then you
railroad
go
track.
2 more streets, and Joe Pesci lives there.
Sure. Yeah.
But 2 streets from Joe Pesci, I mean, they're killing each other left and right. It's
amazing, right?
It's absolutely crazy to me. Now I have to ask you this because I'm from up north. I saw in your bio.
Mm-hmm.
Did you work with or you dealt with the Bank Association of New Jersey?
So our corporate headquarters is out of New Jersey. So again, their affiliation, just with licensing and things like that. But we're actually, we're what's called we're a direct lender is what we are. So we're not a broker. I don't need to go find investors to loan consumers or buyers money and play the middleman. We have those capabilities where we can broker out if there's a niche program or something that's not offered. But we loan our own capital as a bank. We basically do everything in-house, underwriting, processing, originating, and we're actually the one funding the loan at the end of the day. We're writing the check to basically funds the loan at the closing table. So the benefit in that really is we have control.
Wow.
So it's a world of difference in this industry, to be honest.
Sounds
with
like
you.
a beast company,
Yeah, what's great about it is we're growing. We're younger and hungrier company, but like I said, they have basically a lot of knowledge and they're growing quickly. So that's why I'm happy to be part of it.
And now, how have the market guidelines changed?
Market guidelines such as with
like the market lending prices.
So so like I mentioned, most counties have what are called county loan limits.
Now, is that just here in Florida or
throughout the country?
Throughout the country.
So say for an example in like New Jersey, a lot of the counties have higher loan limits, 500, 600, 700,000, depending on which ones. Most of Florida, for example, we follow Fannie Mae and Freddie Mac guidelines right now, which is 510, 400. Unless you go down to like the Keys, Key West, it's a little bit higher in Monroe County. But yeah, what that basically does is it takes an average. So for an example, in Connecticut, for example, right, and in Greenwich, whatever county that is, I don't do a lot of business in Connecticut, as you can see. But for example, the median home price is a lot higher than typically 500,000. So they put county limits to basically average the median housing price to be able to stay and allow people to get financing in those aspects. So the marketing is constantly changing. January 1st, the loan limits here are actually increasing. I want to say it's 548. Don't quote me on that, but it's 548 and change up from.
What does that mean, though?
So it basically means that you can borrow up to the county loan limit. So on a conventional loan right now, you can borrow up to $510,400.
Okay.
And what that allows you, that's the max limit before you get into what's called a jumbo loan. So you can't, if you're going to be buying $1 million property, you're up into what's called a jumbo loan, anything over that county loan limit.
Yeah, and what is a jumbo loan and a there was a conventional loan and a jumbo loan.
Right.
That's pretty
So a
much the
jumbo
difference?
loan is it's the loan amount itself.
And then how is, this COVID thing affected, well, it seems like it affected you positively.
To be
I'm not
honest,
quite sure how.
Yeah, it's something that nobody was expecting, right? So as of March, one of the great things about, again, with my company, they're very cutting edge on technology. So we were kind of set up in a way to be able to work remote, and a lot of the technology that we have already set into place. We didn't really we didn't fumble. A lot of the big companies out there, the big banks, they're still kind of fumbling in a way because they weren't ready to be able to flip the switch from working in an office aspect, being able to work remote, right? So like, how many businesses can we sit back and look at right now of how it's been affected by COVID? And a lot of it's just because it's not ready for the virtual world, right?
Now, do you think do you think it will ever go back to the way it was? I mean, because now, like from what I'm seeing is that
Sure.
big companies are saying, well, I really don't need to pay this guy to be in here. He can
The
do
office
everything
space.
from home.
Right.
Right. And he or she can do what they want from home. And, this is what you need to get done today. And you can kind of do it on your own time at home.
Right.
And they don't have to pay for that office space anymore.
You know what we've actually seen? Because, again, we look at, obviously, production levels and things like that. So I'm actually the branch sales manager in my office. And I have 10, 12 loan officers under me right now that also I obviously help out through the process. And
Congratulations on that.
I appreciate that. Hard work goes a long way in some aspects.
Yeah.
But what we do is we look at people's production, right? And what we've noticed is people's production level actually went up from working at home, believe it or not. And myself is guilty as well, just due to the fact that in my aspect, I have a computer there, so I work until midnight, sometimes wee hours of the morning just because I can, right? And when you're in an office environment, you're working until you leave the office. Difference is that you're at home and you're working from home, you don't stop, you know what I mean? You're still there, the opportunity's still there. If there's stuff to get done, a lot of times people push it off from an office aspect. I got to go home because of X, Y, and Z, make dinner for the family. They leave work at work, right? And they cut it off at 5:30. But if that person was working from home, a lot of times you see their production a little higher because after dinner they'll jump back on the computer and knock out what they have to do.
Because you kind of know what you have to do for the day, right?
Sure.
So you can do it on your own time, and you
Right.
know that, like, as long as you have it done by the end of the day, you've
Right.
got done what your goal was.
Sure.
But if you're in an office, you got your girl, wife, kids, whatever you might have calling you, hey, where are you? What are you doing?
Right.
So you might not finish everything you need to finish. I'm just giving you what I've read.
Sure. No, when you leave the office, right, they leave it at the office. So what I'm seeing, and from an economy standpoint, I guess, if you're asking my personal opinion, what I think is going to be a big downfall is the retail space. Right?
Oh, dead.
Big box retail. I had people, I hate going to the mall personally, but I had friends and family who were in the mall this weekend. And we're in Christmas time, right? Usually it'd be a madhouse there.
Mm-hmm.
They're like, you wouldn't believe it. There's nobody here. It's hard to believe, right? It's just got everybody, the pandemic's got everybody so scared of public that the big box retailers, the mom and pop shops that are in the mall, the little kiosk owners in the mall, that they live off foot traffic, right?
Yeah, but you do commercial loans too.
We do.
Not, right.
Yeah, so I do residential and commercial.
Now, have you seen that going down to the poops?
Depending on the aspect, right? So what the guidelines for say has definitely got more tight when it comes to, like, say, restaurants, because again, the investors now on the commercial side are kind of pulling back and scaling back from restaurants, hospitality, just because they took the biggest brunt hit of the decrease in business, right? So yeah, we have seen a little bit of changes, but there are also a lot of, like, multifamily residence commercial. So commercial lending for residential commercial lending is anything over 4 units is considered a commercial property. So like apartment buildings, things like that. So that investors love because they know that people need that's secured money, really, because they know that people need somewhere to live.
So like a 2-home place isn't considered that.
It's still considered residential.
Anything
over 4 units, like attached 4
is
units.
that a duplex?
A duplex is a 2-unit.
Okay, and then
A
what's
triplex is a 3-unit, and a quadplex is 4.
Okay, I see. And then you were saying about the benefits of refinancing.
Yeah.
So you get stuck in a shitty loan, basically, or
I
deal.
couldn't even call it a shitty loan. A lot of people were in loans that were great at that time.
At that time,
Sure.
you got yourself into a situation that benefited. It helped you out at the time.
Say you bought a house 3 years ago, right?
Yeah.
Or 2 or 3 years ago, whatever the case may be. Say you had a rate that was in 4.25 or 4%. That was great rates then. It's just because, again, the market took a little bit of a dip. on certain loan products, I'm locking rates in the twos in some aspects. Again, now it all goes off the qualifications of the buyer and the borrower to fit into that box. But yeah, interest rates now, if anybody that owns a home right now and hasn't looked at an opportunity or have given me a call to look at what options are out there for them and the family, they need to do it as soon as possible. Because again, we really don't know what is going to happen here with interest rates.
Can you pull up his LinkedIn, please? So how do you think this is all going to turn around? Forget about the election thing because it's too political for you to talk about as big as you are and whatever. You have people that won't talk to you if you say the wrong thing.
You always want to stay away from some politics, right?
But how do you see this turning out? Not who's going to win.
The economy-wise, or
yeah, I mean mortgage-wise, real estate-wise.
You know what, man? If I had, that's like having a crystal ball here.
Yeah, I mean, just your opinion, just because you're dealing with this type of lending thing all the time.
Sure, I think that certain markets like Florida is always going to be a strong market. I think it's going to increase just because, again, we're seeing a lot of people out of the Northeast. It's just there's so much change, right, across nationwide, just in business-wise. A lot of people that are working for certain situations, a lot of people got laid off. Unfortunately, I had borrowers that get laid off throughout the process.
Now, what do you do then?
Unfortunately, they get denied. Their process ends, and we got to regroup and figure something else out. You got to get another loan, but unfortunately, without employment, that is one thing that we've seen with the whole pandemic situation is the guidelines on employment. So we're calling as the day of closing to make sure that they still have a job. Just because, I've heard horror stories that people lost their job on closing day.
Really?
Yeah, it's heartbreaking, but
fucking crazy, man.
Yeah, exactly. So,
yeah, I don't see how the mom and pops are gonna come back. You know
what it is? I really think it's just gonna be depending on the business that you're in. It's crippling people left and right, unfortunately. And then you see other companies that are just growing substantially and exponentially that it's hard to explain, right?
See, and don't you answer this because of your situation. But I just don't think, I think no matter what, you don't shut down because, in my opinion, you have that choice to go out. You know what the risks are.
Yeah.
And if you want to go out, put a mask on, wear a shield or whatever you want.
Be safe.
But to control you and say you have to, like California, what the hell? I mean, everybody's moving to Texas, Arizona. I mean, I can't tell you how many people I know that moved. New York?
Yeah.
That's a whole other ballgame.
We're seeing we're seeing a huge influx down here in Florida from people from the Northeast, right?
Yeah.
Jersey, Pennsylvania. You're from Pennsylvania, so I'm sure you have friends and family that are like wanting to get out of Dodge.
Oh, yeah.
Not to mention it's snowing there, so it's not as
appealing.
appealing.
A lot of them are actually going to Delaware.
Really?
Yeah, well, they don't have tax there. Or Delaware and Wisconsin because the state tax is good.
Sure.
Like business owners and stuff
right.
like that.
It's another big thing with Florida. A lot of people are trying to get residency down here because of the zero state tax.
Yeah.
So
so you do think everything will bounce back, or you're kind of like, eh?
I think it's going to be certain areas, man. I think it's really going to be certain demographic areas that are going to bounce back. Just again, I think Florida's going to be all right. Just because, again, we're in paradise, everybody says, right?
Yeah.
And just to be the way that it's been handled.
Well, DeSantis, he's not going to shut down anything.
That's what he's saying. He's definitely not believing in the shutdown. So
he says that, though, but still things aren't open like they are. But, that's up to the business then to open it, though. So he could say, look, open everything up, but the business itself has to open up, right?
Yeah.
But you know what, Jesse? I had a DJ in here, right?
Okay.
His name's DJ JR. He does like big. He was booked the entire time at Sunfest, down in Miami.
Okay. Yeah.
And
or Ultra, you mean?
Yeah.
Ultra, right?
Well,
Sunfest is here in Palm Beach.
Yeah. No, Sunfest in Miami.
Oh, there's a Sunfest in Miami
like the
now
big
too?
one where like everybody comes in.
Yeah.
He was booked for the whole thing to be the DJ.
Got it.
Well, they canceled it, of course.
Yep.
So, and what he was saying is that they opened it up to an extent, but depending on who it is, can shut it down.
Right.
You know what I mean? But then if you want to go protest, you can go protest with no mask on. And
right.
It's just such a killer,
It's funny what they consider safe and unsafe, right?
And for him, it just killed him. It killed what he was doing. So he's into photography now. He opened up a studio to do photography and stuff like that.
Sure.
But, this is one of the top DJs down here.
I actually had a client that was a photographer, and most of their income streams were from weddings, right? What happens with weddings now? You're going to do a virtual wedding? Who are you going to take pictures of besides the bride?
Yeah, we're going to do it on Zoom or Skype. I tried to do a Skype interview.
Yeah.
It lags.
Sure.
I tried to do a Zoom one. I wanted to kill myself after I tried to do that one.
You know what's funny is
Actually, Rob tried to fix it. It was still a nightmare.
You know what's funny is a lot of these companies that you're seeing, like Peloton, the biking,
The running one, the treadmill, yeah.
that skyrocketed. Zoom stock skyrocketed. Big tech stocks shooting through the roof, right?
But
Lab
isn't
stocks.
China behind Zoom?
I don't know. I wouldn't
That's the
surprise
word on
me,
the
to be
street,
honest.
though.
Is it? Is that
Yeah.
what it is? I know they're
Yeah.
behind TikTok, right?
Yeah.
Yeah.
Have you heard that he's like Mr. Studio guy?
Yeah.
Have you heard that Zoom or China's behind Zoom?
I haven't heard that one. I know TikTok, like we've said,
Yeah.
and
Yeah.
tracking information and all that good stuff.
Yeah, he worked for NBC, Fox.
Oh, really?
Yeah, I'm lucky to have him in here.
Yeah. Look
Yeah.
at that. Credentials. I like that.
Yeah, you ever hear the Kids for Cash case?
Kids for cash. No.
You got to watch one of my interviews.
Oh,
He was
okay.
the reporter for it. Okay, so here's your LinkedIn here, and you got a lot of people after you, huh?
You know what it is right now too? It's always this time of the year that a lot of companies out right now are recruiting. Business is busy. So
Yeah, it's I didn't think LinkedIn was that big
mhm.
until I started messing with it just for promotional purposes, you
yeah.
know. But I mean, it's a huge thing.
Yeah, no, a lot of people utilize it. I probably don't utilize it as much as I should in most instances. I definitely jump on there just to see what's going on. But it's just any social media platform, right?
It's just all so time consuming,
yeah,
you know.
it is.
And then you hire someone to do it, and they don't do it right, and
Right,
it's just a
right.
disaster.
It's social media, man. That's where everything's going today.
You're right.
It's good,
You're
bad, or
right.
indifferent, but it's going to be there. So,
You're right.
and that's just the way the marketing is too. That's another thing. TV, man. How much soon? When are people going to be quit watching actual like broadcasting networks?
I think it's really close.
Yeah,
Because why?
right.
You don't need to.
You don't have to watch the commercials, but now
Yeah.
you're seeing it on like social media avenues too, right?
Yeah, but you pay $15, you can get out of it, and you
Get
can
out of
watch
it.
whatever you want.
Right.
You know what I mean?
Exactly. So it's a great question. Where is it going to be here soon? I don't know.
Now, one other question I have to ask you before I let you out of here, right? So when I first moved down here, everybody said, look for I asked Gary this,
The
Wall Street
foreclosures.
Gary.
Right,
Yeah.
right.
Where the hell are all the foreclosures? I thought they were all over the place.
That's what
I didn't see
everybody
any.
Says, and again,
That's like the rumor up north, right? You fly down, you move down to Florida, you can find a house for
dirt
pennies,
cheap. Right.
and you just flip it and you do this. I looked around for 7 months. I didn't see anything.
Right.
Anything that I wouldn't even put a cat that I hate in that place.
Right. Right.
You know?
Sure. The foreclosure business, what it is that's a great question. What they're doing is a lot of, for pandemics purposes, right? A lot of people have gone into forbearance. A lot of the banks are out there definitely trying to help people because people that have lost their jobs, so on and so forth, they put them on what's called a forbearance to where you don't have to make your mortgage payment for a certain amount of months, depending on the loan program. And some banks are requiring that to be due when, say, if they give you a 6-month forbearance, sometimes they want that due at the end of the 6 months in full. Or what they're doing is they're putting it in a second lien position, silent second lien basically, where there's no interest or anything. But if you were to refinance or to pay it off, that would be paid back to the bank in full.
Now, like I said this to Gary, so what do you see happening? Do you see like the foreclosure? Like if this shutdown continues to happen, now aren't you the one who's gonna have to deal with this if they can't pay their mortgage?
You know what?
Or no. He was talking about that they passed a thing where you can convict people now out of their home.
People, I haven't heard really much about the foreclosure wave.
Yeah, sorry about the foreclosure. I meant to say where that if you're not paying like before, you couldn't kick somebody out for 6 months.
Right. They stopped people, for example,
Yeah.
you're talking about renters, right?
Yeah.
Yeah. So where you could actually not have to pay your rent because, again, a lot of people were getting help on paying the mortgage, but it all depends on utilizing it right for the right thing. If you had a tenant, right, and you're a landlord and you got help not paying your mortgage because your tenant lost their job, so yeah, you're not going to evict that person.
But no, he was talking about mortgages too, like what you're doing, like loans.
To proceed with the foreclosure proceeding.
Yeah.
Yeah, so people that are start late payments, but a lot of the big banks are trying to help people if it's modifying their loan, so on and so forth. So to see where the foreclosures are coming, that's a Gary question.
Are you concerned about that though? Like
It's
in
always
your
concerning.
position?
It's always
Yeah.
concerning in an aspect of what's going to happen in our industry, right? So if there's a lot of foreclosures, that's typically going to tip the market values. For example, if you go into a neighborhood, right, and there's 4 foreclosures, you would assume that they're going to be because a lot of people by the time they get to foreclosure, they haven't made a payment in 4, 6, 8, 10, 12 months.
Right.
Sometimes if not longer. It depends on how it goes through court. But a lot of times people are disgruntled at that point, and they take the appliances or they pull out the wire in the walls. Who
And
knows?
then
You never know.
Here's the place with
You never know what
a
type of
black
property
cat
it's going to
now.
be. Yeah, exactly. So now that opens up for investors to come in and actually pick up those, and hopefully in their mind at a discount. So now you have a comparable sale in the neighborhood that was much lower than what everything else is going for. So it could kind of rock up or shake up our business a little bit when it comes to market value or the market curve that we were speaking about before. But that's one way we'll
It's
find
kind of
out,
just
right?
all up in the air.
There's so much uncertainty. How long can this last? Is
Yeah.
it going to last? Is it going to stop?
I'm just I'm just surprised with the COVID, and nobody really knows what's going to happen with the election. That the market and the real estate's so high. I'm shocked.
We definitely live in a different world, I could say, right? And we're gonna be talking to our grandkids about this.
Yeah, I mean, this is. I don't think you're gonna ever see this again.
Yeah.
I mean, this is some nutty stuff here.
It is.
So now, if somebody wants to get a hold of you, because I've talked to you personally, I've
Sure.
sent people to you. Well, what's the best way to contact you?
These days, you know what it is? It's my cell phone number.
Your cell phone number?
Yeah, it should be listed at. I'm sure you put up the my contact info later on, but
Yeah.
my cell phone number. It's always I have it in my pocket. I'm not a 9 to 5 guy. If my phone's in my pocket and it's ringing, I'm gonna answer it. Even on the weekends, the whole case. Like I said, it's our job. It's unfortunately we're not a 9 to 5 position.
It's,
so
it's one of those things. Yeah.
Right.
Yeah, I have all that. I have your LinkedIn in there. I have your website in there. I
Yeah.
have your phone number.
Yep.
And
Email address, shoot a text, give a call.
Yeah, I think we've all learned a lot here. I mean, you just blew my mind.
Gave it all in a nutshell. Like I said, we could sit here and talk about this for days, but if you have a home right now and you have a mortgage, you got to look at the opportunity that's on the table. So, like I said, give a call, whatever the case may be. Shoot a text, shoot me an email, just an overview, and I'll be more than happy to have any conversation with anybody or any of your followers, so on and so forth.
And if they can't get it done now, you'll explain to them what to do
and how
so
to get it
that
done.
you can get it done for them.
Sure. A lot of
Awesome.
people are always holding back because they don't think, and you'd be surprised the way that loan options are out there. So
Well, there's not a lot of people that will deal with it, though. You know what I mean?
Right.
They'll call and they'll do like a quick, pre-approval or whatever, and then they're done with
Right,
them.
right.
They won't say, look, hey, how about you do this and this, and then maybe you follow up with them in 3 months and say, how you doing?
right.
Not just to get the sale, just to try to get the job
Help people.
done.
Sure.
You
I
know,
know
and-
somebody that's been
you know.
saying they're going to get me loan documents for a long time, and I haven't got
Yeah.
them yet.
Friday.
Okay.
All right.
Whatever's good
Thank
for
you
my
so
friend.
much, Jesse.
Hey, my man, thank you so much. I appreciate you having
All
me.
right, you
okay?
got to come back in again.
Sounds good.
All right.
We'll
Thank
talk
you,
soon.
Jesse.
Be good.